Ever pondered how a handful of individuals at central banks can sway the Forex market? It's a fascinating thought, isn't it? And the truth is they do, and in a big way. Central banks stand as the pillars of the global financial system. They are the conductors of the monetary symphony, controlling the tempo and volume of money circulating in an economy. They define monetary policy, set interest rates, manage inflation, and do all they can to ensure financial stability. But their influence doesn't stop there. They also hold the reins of a country's currency value. By tweaking rates and policies, they can make currencies dance to their tunes, affecting the Forex market in ways that ripple across oceans. Whether we realize it or not, their decisions shape our financial world. Indeed, these financial giants have the power to make or break economies. But how do they do it? Central banks have a potent arsenal at their disposal, and their weapon of choice? Monetary policy. Imagine these financial institutions as the puppet masters of the Forex market, pulling the strings of their currencies with the tools they have on hand. First in their toolkit is interest rates. By tweaking these rates, central banks can influence the attractiveness of their currency. When they hike up the rates, their currency becomes a hot ticket, attracting investors seeking higher returns. On the other hand, when they lower the rates, the currency loses its allure, causing investors to look elsewhere. Next, we have open market operations. This is where the central bank buys or sells government securities in the open market. By doing so, they control the money supply, either pumping more cash into the economy or draining it out. So, by adjusting interest rates and controlling money supply, central banks can steer their currency's value in the Forex market. Now you may be wondering, how does this all play out in reality? Well, let's take a spin around the globe and see. Imagine it's 2020. The world is in the throes of a global pandemic and economies are reeling. In response, the US Federal Reserve makes a dramatic move. It slashes interest rates to near zero. This is a big deal. Lower interest rates mean cheaper borrowing costs, stimulating economic activity. But here's the kicker for Forex traders. Lower interest rates often lead to a weaker currency. In this case, the US dollar. Now, picture yourself as a savvy Forex trader, catching wind of this news. You could act on this information, trading against the dollar to potentially make some tidy profits. As you can see, the decisions made in those central bank boardrooms ripple out, causing waves in the Forex market. You've got the knowledge, and now it's time to put it into action. The world of Forex trading awaits you, beckoning with promises of potential profits and thrilling ventures. But remember, this isn't a simple guessing game. With the power of understanding central bank influences, you've got a secret weapon in your arsenal. Central banks, with their monetary policies and interest rate decisions, are like the puppet masters of the Forex market. By keeping a keen eye on their moves, you can predict market trends and make calculated decisions. Think of it as a dance where you move in sync with the rhythm of the market, guided by the tune of central banks. And the reward, potentially high profits and the thrill of the trade. Your journey towards Forex success begins now. And remember, CocoShell.com is your go-to platform for the best expert advisors for automated Forex trading in MetaTrader 4.